Turn it up. The old sheepdog.
Here's what I'm picturing. David Hoffman in this crowded
Shirt off.
club, just yelling into some girl's ear, like, "Have you heard about the merge?" She's like, "What? The merge?"
Like the meme?
yeah. It's that
But
arm around tight.
I just see a shirt off for some reason.
Well, we're going to find out tomorrow night.
So that's the first sheepdog song I've ever heard. I'm pretty excited.
Yeah, it's cool. It's a little Black Keysy. It's going to be a fun show.
So we're going to the Sheepdogs concert tomorrow
Maybe the Black Keys are sheepdogsy.
Ooh, you're right.
with Mr. Hoffman, who's on his way, flying in right
En
now.
route.
We got a big weekend, and we have 3 really good episodes for you guys today. I'm pretty pumped. Steven's very pumped about the agenda, about the content, what we've got on the content sheet there in the Notion.
Good content, Cal.
Yeah, you're pretty happy about that, aren't you? Yeah, I know. And so we're starting with money, and let's see here. We're drinking some Dry Farms wine. Don't forget the links below. Check them out.
This stuff is good.
It's very good. We're drinking it.
What's
And,
the code?
There is no code.
Oh, it's just the link?
It's just a link,
Okay.
I think. And you get an extra bottle for a penny if
Cool.
you use our link.
That's a sweet
which
deal.
is very cool.
Good deal.
So what are their announcements?
I think that's it.
All right. Let's pop it in.
We go
How do
right
we
in
kick
the
this off?
alfalfa round?
Yeah.
Okay. So I don't have any trades this week, but I do want to share some alfalfa from a net liquidity update. I'll try to make it quick.
You love net liquidity.
I do. I mean, we talked about in the podcast.
Yeah, talk to me about it.
Got kind of like a net liquidity thesis going on, and I kind of want to see it out until I'm proven wrong. So just a reminder, net liquidity is the Fed balance sheet minus the reverse repo facility minus the Treasury general account balance. Risk on assets have kind of followed this net liquidity calculation like hand in glove. And yes, our precious ETH is another risk on asset, just like the others. Last Friday, net liquidity was at $6 trillion, which correlates to about $3,800 S&P. The net liquidity value of ETH at that net liquidity amount was around $1,000. So it's already running hot compared to like the net liquidity value. And Darius Dale at 42 Macro is a guy who kind of came up with this calculation. He's projecting net liquidity to go down to about 5.6 trillion, which correlates to about 15K BTC and $550 ETH. So here's the deal. ETH is currently sitting at 1250. And even if you disagree with that price target of 550, I think directionally, if you believe in the net liquidity thesis, the gravity of liquidity getting drained from the economy could pull it down. I guess you could say that, I guess there is a thesis that like right now ETH is running hot compared to the net liquidity valuation. And people could say, well, that's because of the merge changes. There's no miners capitulating. There's not as much sell pressure. So even if you applied a premium, like ETH deserves a premium over that net liquidity calculation. If you take the premium it has now and add it to that price target, it still puts ETH at $850 to $900 by the end of the year.
Ooh, and do you think Bitcoin's running hot relative to the liquidity calculation?
It is leading it much lower. So it's actually significantly lower. And I think Darius showed that, in previous run-ups and decreases in net liquidity, Bitcoin leads. It led on the way up in, I think, 2020.
Got it.
2021. And it led down this year. It was the first to move.
So that like leads into my alfalfa pretty nicely. I've been short shit coins for a long time, and I'm still holding true to that. And I think like I've expanded that now to go short Bitcoin mining companies, publicly traded Bitcoin miners, and these guys are like
How many of those are there?
Several,
Like a basket of like 5 or 6, right?
and like they're going bankrupt. Like,
Do you have a favorite?
well, a lot of them have already gone bankrupt. Like this is how bad it's getting. The one that I'm really keying in on is Marathon.
Mara.
Mara, and that's like because it's the last one, still kind of like holding on, and I'm like, you're going down too, pal. Like Bitcoin mining is like unprofitable at an operating level right now, and these guys are over levered. They're like they have old equipment that needs to be replaced in 2 years.
I'd like to buy that equipment.
Yeah, I think like long term, but like if this protracted downturn lasts longer than maybe the next 6 months, I think they're going to run into continued trouble. So, and then you also have like the balance sheet issues. I've been short those guys last week. It's already doing pretty well.
How are you shorting? Are you buying puts, or are you actually
shorting on TradFi? Just
shorting
like
spot?
Shorting spot. Okay. Yeah.
Cool.
Yeah, that's a gross looking chart. Wow. Cool. Nick, did you ever add that indicator?
Which
that I
indicator?
sent, the net
I
liquidity
did
one?
not add it.
Oh,
I didn't even find it.
that's some good alpha for you.
Well, it was on the paid version of TradingView, which I don't have.
You need to have like a non-free trading view.
Yeah.
And it's like the mid-level version. I think you need to
I think the
add
exact
the indicator.
name of the indicator is like News Age Net Liquidity. It's pretty good. It's like an RSI indicator for liquidity, and it's literally called like the last 8 tops and bottoms.
So does it? It measures the relative strength of liquidity.
Yeah, it's sort of like how overbought, quote unquote, oversold liquidity is.
How it's trending. So what's it telling you right now? What do you see? Do you have it pulled up on the chart right now?
I checked it a couple days ago. It looks like there's actually room to go to the upside still on the indicator. Anyway.
Is it using the same net liquidity calculation that we're familiar with?
Yeah.
Wait, hold on. Room to the upside, meaning liquidity could be drained further? Or
No, like there's more room up for
Like
risk
the-
assets.
Oh, okay.
Which kind of makes sense. Like I was looking to get, I almost went long ETH this
Man, how
morning.
about that like S&P chart that like hit the exact, like
The magic diagonal line?
the diagonal
Yeah.
line. I obviously I don't like care about technicals, but I see this and I'm like, well, it seems to bounce off of it exactly.
Should I repost it in the Discord?
Yeah, I mean,
It's just like this dumb line that like it just
that just
happened to
bounces
work.
off of.
Yeah.
Sometimes the lines, they work. It's the simple things.
Yeah.
Ooh, line go boing. Don't go long.
Did people sell because of the line, or is the line there because?
It's an interesting.
Ooh, Ziggy.
Sorry, we got
Easy,
a
bud.
Excuse me, I have a loud dog over here. Excuse me,
There's a,
Mr.
yeah.
Ziggles.
Disgruntled.
FedEx
Please.
delivery.
Ziggles.
Please be quiet. I'm trying to teach the audience.
I think they're delivering more wine.
Dry farms.
That would be sick. I
She had
want
a-
more.
That
she had a
would be
case in
sick.
her hand.
I want as much as I can have as I'd like it.
Speaking of,
Is that
where's
enough?
that bottle? I can pass that
Wow.
Stephen finishes.
Yeah.
Not more than needed.
Before Steve
Just enough.
finishes.
Anyway, no, I just wanted to sort of go on record with a potentially poorly aging prediction.
Oh, we like these.
Yeah.
Yeah.
I think much to the chagrin of David, I do think we're going substantially lower.
Because he called trading in a range of like 1,000 to 1,200 for the foreseeable future.
Yeah, certainly plausible. I mean, when I look at everything, it seems like Bitcoin wants to go down like at least 30%. I think that's like the optimistic case. But then if you chart everything versus Bitcoin, it still looks like everything wants to puke like another 50 to 60% at least.
So throw a number.
Against
Throw a
Bitcoin.
number out. An ETH number.
Well, that would, for alts, like a lot of alts, that would translate to like another 65, 75% down,
Ooh.
which is pretty brutal.
Stings.
I think
Not
ETH,
if you're sure.
I think I'm ready for that actually.
I
Wedding
still
willing.
think ETH BTC looks like trash, honestly. Like I know everybody's like, I love ETH, it's going up. But when I just look at it, it looks really heavy. It looks like it's got a minimum 30% correction in it, maybe 50 if it gets really bloody. I don't know. But if Bitcoin goes down 30 and then ETH goes down 30 versus Bitcoin, I mean, that's like almost a 50% haircut on ETH. So do the math on that.
Yeah, I think there's an important distinction to make because like there's a lot of talking past each other on Twitter because like there's one conversation which is like, is this in general a good long-term buy position? And yes, this is probably still a great long-term buy position. It's probably a phenomenal one, right? But like that's a different question than what's going to be the Pico bottom. And so, yeah, we're kind of like playing with fire here, just trying to talk about what the eventual bottom is, but you got to figure out which bucket you fall in. Are you just trying to like find a really good long-term place to accumulate and not, find the exact
I'm
bottom?
definitely not mad buying 1,200.
way.
Not mad, but I'd be happier buying 800.
Might be. I don't know. It's not even that crazy. Like Bitcoin went down 84% in 2018, and it was, comparable market cap to ETH today. Like that puts us at like 770-ish ETH. Like that's not crazy. And that was a 84% in like a macro mega bull market. So we still don't, I can't stress enough that all these indicators and all the magic charts and everything everybody uses, like all the on-chain stuff, it's all only existed in like one macro paradigm.
How do you feel like NFTs do in a macro bear market?
Oh, you mean the most illiquid part of the riskiest asset class on the earth in a liquidity down cycle?
I'm specifically talking about a brand new NFT.
I think premium
One of
ones
the
will
best
do
transitions
pretty well.
I've ever seen in my life.
How do you think
teed you up, baby.
CØCKPUNCH will do in a?
Did you just
bear?
Kobe to Shaq?
Yeah,
Alley-oop
I
to
loved you.
Armand?
Yeah, it's incredible. Shall I slam dunk this? No.
That was awkward. I thought he was passing me the ball still, and then he like
No.
fake behind the back.
Yeah, you didn't
Still
catch. But
spotting
that's
up.
what made it such a good transition. Is you didn't even see it coming.
Does that make it good?
Yes. You don't see. Anyway, we'll flick the lights. So you guys want to talk cocks? So minted
said
cock
punching
punch
of-
this morning. Punched myself in the old cock, and yeah, I mean, so it's been quiet for a long time, right, in the NFT space, and I think that's a great question Eric just asked, but. We talked about this last week. Tim Ferriss launching his NFT. There was a bunch of drama around that on the bankless side. But as I mentioned, I've been following Tim Ferriss since he came out with 4 Hour Work Week, like many of you guys, and huge fan of just everything. Learned so much from the guy. He's just very good at synthesizing and delivering incredible value to his community. And I wasn't like stoked about the way he presented the launch, but the launch itself went very well. Everything was fine.
Smooth.
No kinks. No. Cool. Yeah, he used pre-mint. It was great. I got 4 and immediately flipped 1 to
What was the mint price?
mint price was 0.3 ETH. Got 4 of them and sold one for 1.9.
Oh, baby.
Oh, well done.
House
1.89.
money, baby. Let's go.
And yeah, recouped.
We're going to Sizzler, boys.
Recouped and have another one listed for the short term. I think that's around close to 2 ETH. Another one at the same price range, and then got one for the medium term and got one for the long term.
Cool.
Let it
My
ride.
medium term is going to be. So just to take a half step back, yeah, this is like the biggest NFT launch we've had in quite a while. I haven't looked at the volume. I don't know if any of you have. Let me actually have it
Was
right
it like,
here.
did someone say 500 ETH?
So aftermarket volume on just OpenSea right now, pretty wild. In the first 10 minutes, it was like, I think I texted you guys. Damn,
I think you said 500.
yeah, that was just the first 10 minutes.
Okay.
After
Now, are you purchasing? He said to purchase it like a for entertainment, like a trip to Disneyland or an Airbnb weekend. Same price to mint, same price. Like, are you viewing it as that? Like the last few you're gonna hold? Is it like, well, maybe I'll get entertained enough for $400?
no, I
course
think
not.
that was advice. That was advice to a person who's going to mint one and doesn't know what they're going to get out of it. And I think that was good advice that he gave to that. I think he was covering his ass and making sure that everyone's happy and that they understand, like, he's not in this necessarily for the long run. The thing about Tim Ferriss is that he's never not over-delivered. He's always under-promised. That's the way he likes to roll. He doesn't like commitments. We talked about this. And he over-delivers. My favorite line from the FAQ for the mint was CØCKPUNCH, which, just for people that don't know, the way he's doing this, it's basically like it's a fiction book, but in the form of a podcast. And he's telling a story with these characters. There's 5,555 of them, so about half the size of a normal collection, which is really cool. And then you've got probably 5 to 10x the demand of a normal popular collection. So those are all positive. It's an emergent fiction story that he's going to be telling over a series of time, but he doesn't want to commit necessarily to like 6 months or 12 months or no roadmap, no utility, no nothing. But what he did say, which I got excited about because I know he's done this in the past before, was that this entire NFT launch and collection is a Trojan horse for something else.
Yeah.
And he's always done that. And that's what I think makes it cool. Like, what will it be? I don't know. I could fucking say anything and it could be true. It could be a event pass one day. It could be a mastermind
He's
thing.
pretty
It could
closely
be-
tied with Kevin Rose, and that guy's
Exactly.
delivered plenty of value to his NFTs. So I think there is reason for optimism for sure.
And you donated to psychedelic research, right? Which is something you
Yeah, I mean, the guy raised $2 million off the launch.
Cool.
Finally, the thing loaded. We're at 3,000 ETH volume on the day of the launch at 4 p.m. So that's a lot.
That's pretty good.
That's pretty good. And his creator fee is 7%.
Damn, degens are going to degen. That's,
So, yeah, everyone's trading this thing, and a certain number of people are going to hold and see what happens. And I'll definitely hold one, maybe two. And the rest is just like,
Is it number one right now?
oh, yeah.
Gotta be.
Yeah.
do they have what's their tagline? Cocks, like
Yeah, just giant cock. No, you mean tagline on
just mean like
OpenSea?
for you and your hodler brethren. Like, what do you say to them? Like, cock strong. Don't go limp. Don't go limp, boys.
You know, one thing I'm sad about, these are the areas where, again, I admire Tim Ferriss for how he showed up over the last 15 years, but he's so non-committal that he doesn't want to do any, he works so hard already. Like, he worked, where Tim Ferriss puts his work is into the collection, into the fucking details of things that no one will ever care about. And I admire him so much for that, because like, he cares about the art. He cares about those things. But what people really want is like, give me a Discord to jump into. There's nowhere to even talk to people right now. Because why? He doesn't want to manage a Discord. He doesn't want to manage like any extra
website.
ongoing recurring work.
Damn, that's a landing page. That is
Dude, he
sparse.
always keeps things simple. He always keeps things very,
He's gonna
very
put the
simple.
podcast.
There's
It's
a
gonna be
Cock Punch podcast, apparently.
That's
He's-
what
he
this
has,
is.
I think it's gonna be.
That's what it is, though.
It is
That's what you're-
podcast?
that's it. You're buying.
But
that's
your
what you're
bullish podcast?
basically-
You're buying like a Game of Thrones like series.
buying a
of-
character in
Yeah.
the podcast, basically, and he probably already has it like licensed to be a Netflix show or something
Damn.
like that. Like, that's where all the hype will show up.
Cool.
So anyway, that's
right.
enough about Cox.
Cool.
Let's move on.
Well, are we gonna move to maybe the king of
The
Cox?
King of Cox.
Speaking of,
Well done. Well done.
Can we talk about this Vitalik article before we jump into the dexes real quick?
Oh, I see what you did there.
yeah,
I
yeah.
did.
We got you, Steven. Don't worry. We'll help
Which
She was slow on the segues
I
there.
was like,
speaking of Mr. Vitalik, he did make a mention of Alfalfa.
Yeah.
He mentioned Alfalfa.
Well,
leaks
he
on
mentioned
Twitter.
Alfalfa. He said the
word.
mention.
Yeah, exactly.
Dude, that's big, guys.
Well, I think
Step
you
one.
could definitely twist the words and be like, well, Vitalik.
Yeah, as tweeted
he
by
thinks-
Vitalik.
What is Alfalfa? Well, Vitalik thinks it's something that could be painful at first, but in the long run, really good for you.
Yeah,
I have
that's
to say, I'm proud
Just
of the
take it out of context and
proud of
Let it
the what do we call Alfalfa Army?
yeah. The
I
Discord.
like the alliteration.
Yeah, the
there.
Alfalfa Army
The
showed
Alfalfa Army
up.
showed up.
it definitely made my heart flutter. I'll tell you that.
They showed up. They fucking spammed
damn.
Vitalik, made sure he knew that, hey, Alfalfa is taken.
Dude, Hoffman DM'd him
Yeah,
or
correct.
messaged him.
DM'd
DM'd him?
Vitalik and was like, hey, dude,
Hey,
Alfalfa is this podcast.
Alfalfa is this podcast. You should look at it.
Yeah.
Maybe.
Well, there's
I'm
four
taking
idiots
liber-
on
I'm
a
taking
podcast that
liberties,
you
yeah.
happen to mention their name and they're just getting all giddy over
I
it.
mean,
we don't know
I
what he
I feel
said.
like he's gonna listen to one episode of this and be like,
I think he's going to absolutely love it, and I think I'm manifesting a Vitalik episode talking about. First of all, I've gained a lot just from his blog, his travel tips.
Totally.
Like, I would
I
love
want
to
travel
dive
and longevity.
Dude, we talk about longevity all the time, the future. We need to have a conversation.
yeah,
with
you want to
Vitalik.
know the non-Ethereum side
Yeah.
of Big V.
Bengals
Yeah.
boys got that covered.
Wait, so what are we diving into?
Okay, so he wrote an article that published 2 days ago, so on December 5th, as the time of this recording. And it's titled, What in the Ethereum Application Ecosystem Excites Me? And essentially, he goes back to when he was first thinking of Ethereum as this multi-purpose blockchain. And he's basically saying like, okay, we've had some time, we've had apps to try things out. Some things have failed, some things succeeded. And he's basically funneled down to like a certain number of applications in which ETH should focus on, or the ecosystem should focus on. The first one is money, and in there he obviously includes like stable coins, I think is the notable one out of that section. 2, DeFi, he mentions keep it simple, like, simple things. He thinks prediction markets are an interesting thing. I don't know if he meant betting markets specifically, or maybe something more general. But synthetic assets. He talks about identity ecosystems, ENS, sign in with Ethereum, POAPs, that kind of thing, DAOs, and then he kind of finishes off with. He actually has quite a bit on DAOs, and then hybrid applications like maybe voting is an example he throws out. So, given this, my question to you guys is, we think this is one of the most dynamic assets out there. Based on his kind of narrowing of the applications, is the total addressable market still big enough?
Great question, man.
Because I've kind of come to the conclusion that there are clearly some things that crypto fits in with, but not needed. But then there's clearly some things that's like just not. You don't need a decentralized, trustless thing for certain applications.
Money, don't you think that's a pretty big TAM?
I do. But he goes
one, right?
he goes on to he kind of sets up the argument that like he mentions it specifically for third world countries where 8% inflation isn't egregious, or it's like minor. They're used to much higher rates of inflation, and maybe they don't mind holding Bitcoin. They don't mind holding ETH. But in the end, he says stable coins are the real killer app.
It's the facilitation of the stable coins. I think that's like the killer app of crypto, right? That's like been my problem with Bitcoin for a while. Like I don't think Bitcoin meets any of these bullet points, right? Unless you want to argue that Bitcoin is money, which I think is currently like a silly argument. You can like argue that it's like a long dated leap option on it being money in like 50 years or something, and then maybe that makes sense.
Yeah, he mentions collateral. Bitcoin could be collateral. I think you've used it as collateral.
But it's like shitty collateral in the decentralized realm because it's not programmable. So you need to like have a third party hold it as collateral.
And it's not even used as collateral in crypto now.
I mean, WBTC is, but it's not.
I mean, on ETH.
That's just tokenized, custodied Bitcoin. So it's like a double whammy of stupid kind of.
I'm pretty sure there's no mention of the acronym NFT in this article.
I saw that. Yeah, it doesn't seem to care about that, which I think is an oversight. That's obviously like a popular element of like what it means to be like a human and like what humans like, and it like they like that stuff. It's going to be used for NFTs. It's a big thing.
I mean, he talked about identity, in like a long paragraph, and obviously NFTs can fit into that. I think he's just sort of like, he as a individual is so against this idea of like speculative manias. Like we've seen pictures of apes go up to hundreds of thousands of dollars, and he's just like so against that. He like donated his like Shiba. He had $2 billion worth of Shiba and gave it away because he like
$2 billion. It was
maybe it was a 1 or 2. It was
the
at least
same
one.
way that like Sam had 16 billion of Solana tokens.
Well, like ideologically, Vitalik doesn't like these speculative manias. I think that's clear, and I think that's why he left it aside.
I mean, I take that back. I guess like the ENS names are an NFT.
And NFT.
So maybe I'm just kind of like
lumped it in under identity,
right?
I guess. I think identity is going to be a big thing in the future. I think just the whole proof of anything is going to be like
POAPs
important
in there,
the
which
future.
are
Proof of human.
POAPs
Like
are NFTs.
it's gonna be like a very weird world to live in short order with like AI and everything.
I'll tell you the one that I'm most excited about that hasn't really come to fruition, but he mentioned was the sign in with Ethereum.
Yeah,
that sounds
underrated.
I think the average person would like that. They don't know it yet, but they don't want to give their email address.
Of course.
When they
the current
use
iterations
login.
are Facebook, Google.
Right. Facebook.
Signing in with Ethereum allows you to prove your identity without giving your information.
Right.
So signing in with Ethereum the same as signing in with MetaMask?
Yeah, you'd log in with your MetaMask or any other wallet or
Whatever wallet.
Yeah, whatever wallet, and you don't have to store a password.
Yeah.
You
Web3.
Yeah.
MetaMask would just be like the app that
One
facilitates
of many,
it, sort of.
But really, the infrastructure.
But under the hood, you are using your wallet.
So we're already
you're
doing that
signing
in
a
Web3.
message,
Yeah.
Yeah.
We would just make it. Yeah.
The fact that we have like passwords and everything and usernames is
insane.
so weird. Like we should just have a like crypto
crazy.
login to everything. The problem is the ability for people to like back up and recover their
MetaMask
stuff.
sucks. That's also a problem.
Yeah, I mean,
most
this is like the area of the space we need to innovate on the most. Still, I think like people are coming out with like interesting products that are like a bridge between the write your stuff down and bury it in the backyard on like a steel plate, which is not really approachable to people. Like we're coming up with technologies where they're like scanning your face and storing part of it here, and then they're doing this and storing that in the cloud here, and like kind of splitting the keys up in a way where it's like recoverable, but like not. And I think we're gonna keep iterating on that. I don't think it's something you want to store like $1 billion on yet, but for like using an identity to sign into the web and stuff like that, it's gonna get there pretty soon, and then this will be like more usable for people.
Mm-hmm. What about the one that I'm most excited about is the synthetic assets and the derivatives markets.
I was surprised that he mentioned that. He said, interesting natural candidates include major stock indices and real estate. I actually would love to have the first synthetic asset would be treasuries. I would love to see the bond market on there. And for the ability to purchase actual treasury backed token that signifies your yield, and you get it in a stable coin, and that would be phenomenal.
Imagine how bearish that would be for crypto right now, though. Like, imagine if instead of like having your money in USDC, it would just be in like a 4.5% like T-bill token. You'd be like, yeah, maybe I'll keep this.
Right. You'll be like, and then everything that has to innovate has to beat that hurdle rate, right? Like,
yeah. Like right now I have all these stables and I can't do anything with them, and I don't really want to cash them out, but also you can't get any yield, and you're just like, maybe I'll just buy some ETH with it. Yeah. But like if you're getting 4% on Uncle Sam guaranteed little tokens, I mean that's pretty sweet.
I hit up for one of our business bank accounts. It's got a larger balance that we don't need. We don't need all the cash right now, and I hit up JP Morgan for like CD rates and money market rates and what can they do to manage that cash, and 3.8% was the money market rate. And then the CDs, if you have over a certain amount, it was like a fucking 3-month CD or 2-month CD is like 3.9. Wow. So, I mean, and you can do these like 4-month ladders where you ladder it and you're getting like a net 4%. I mean, as like a, treasury management, it's
only
phenomenal.
losing 2% of purchasing power every year.
You're real net negative. But, I think we found empirically through living throughout this first year and a half of high inflation, I think there's also research to back this up, that in the short run, cash, ironically, is the highest performing asset in a high, inflationary environment. And then it quickly shifts to like things like real estate, where like, in the medium to long term, real estate outperforms like stocks, cash, everything else in terms of beating out inflation. All right, anything else to touch on?
Not gonna lie, Nick, I thought you were gonna shill our bank.
Mercury?
Yeah.
Why do we have a thing to shill there?
We did that one time, but it's the best bank ever. You have to shill that more often.
I mean, we do use it for Steno.
I'll put the link below.
Okay.
We use it for Alfalfa.
Oh yeah, sorry. We use that for Alfalfa.
Yeah.
It's
And
so
we got
good
Steven
that
still
he
on.
forgot about it.
Steven's still on Wells Fargo.
Yeah.
The fraudsters.
Can I say something about Mercury? Like
Straight Stockholm syndrome at
Come
this
on.
point.
free international wires is awesome.
It's amazing.
Who's eating that charge?
I don't know.
Or
Don't
wait,
worry
was
about
there?
it.
It's not my
There's a
problem.
Ponzi somewhere. Yeah, don't worry about it.
All right. Anything else on the
Speaking
Vitalik
of
article?
Ponzi's.
Yeah.
That's it.
Is that a transition?
Yeah.
What do you
Steven,
got?
all right, we got a Steven specialty coming up, folks.
Needs work.
So set us up, and then we got a bunch of questions for you.
So you guys wanted to talk a little bit about decentralized perps, which I think is an appropriate topic in a post FTX world, in a pre whatever the next thing to blow up is world, which I don't know if it'll be KuCoin or Crypto.com or all of the above, but a lot of money coming off exchanges. Some of it's going back into TradFi, unfortunately, but a lot of it's finding a home on chain, and there's been like significant pickup in volume on decentralized trading applications. So thought it would be cool to do a little overview of everything that's there.
And what we're going to do, we're going to talk about like how to use these as like a user of these platforms, and then maybe we'll also talk about the narrative of these platforms as like an investment. Narrative,
I think both of those are good. I think like starting from the perspective of a user is probably like the most interesting.
Let's do it. Teach me, Daddy.
Yeah. Well, I think if you're a user, you're mostly concerned with like two big players right now. You're concerned with GMX, and you're probably concerned about DYDX.
Yep.
I think there are some honorable mentions in there. Like if you want to trade currencies, for example, like you can't trade currencies on GMX or DYDX, but like you can go long the euro on like I think Quenta has it, which is a built on synthetics on optimism, right?
Yeah, so just to zoom out a little bit, like each one of these platforms has different pairs. Like so there's different trading, like different assets you can trade on each platform, and that's why you would maybe not just go all in one. Because I am a avid user of DYDX, but like it doesn't let me short ApeCoin, so then I got to go to a different one.
Which one would you use to short ApeCoin? Just
I would use Quenta if I wanted to do that.
Okay.
But also Gains Network allows you to do that.
Yeah, Gains Network is worthy of talking about as well. I mean, I've used GMX, Gains, DYDX, Quenta, and no, that's all. I said 4 things, right?
I think so.
Okay, cool. Okay. I've actually used Perp before, Perpetual Protocol, Perp.fi. I don't know, but I haven't used them in a long time. So that was a blast from the past.
So what am I missing in my framework? So like I was like, okay, well, if anyone's looking like, okay, I want to use one of these tools, what's the framework? What's the set of questions I ask in order to make sure like this is a good one? Like I thought of trading pairs, what network it's on. Like, is it on mainnet? Is it on, I think DYDX is on Starkware, StarkX.
Liquidity.
Liquidity.
Fees.
And fees are the ones I have.
Here's another big one. It's like, if FTX just rugged all of its users, what is the chance that I can get rugged on one of these platforms? Does
100%.
does this make me safer or more at risk or the same?
I mean, as a trader, as an investor too, because that's the other thing. Like these programs, some of these protocols allow you to basically be the market maker. Like GMX basically allows you to be the market maker, to be the house. Whereas like DYDX is more like a traditional exchange, in that there's an order book with market makers. So it does. There's a lot of stuff to process here, depending on whether you are like an investor looking to look for yield, you are an investor who's looking to trade exchange tokens as a narrative, or you're like a trader just like looking for execution. Those
Let's
are kind
talk
of
about
like
a
the
user
three things.
first, and specifically like what are the risks in using any of these? I mean, the first one comes to mind is like a bug in the code, right? Like I mean, like the code is faulty. It has a vulnerability.
There's a guy like, what's his name? Avi. Abraham or Eisenberg or whatever the hell. He's going to do a highly profitable trading strategy against you, and then just liquidate all your coins, all your money on the platform.
Yeah, so I think the more decentralized your decentralized trading protocol is, the more vulnerable it is to like some sort of exploit. Like at worst, it's like a bug in the code where the funds are drained, but it also could just be like somebody using the protocol in a weird way, in a way that wasn't anticipated or stress tested, which like results in a loss. But like as a trader, like this is less of a concern for you. Like if you're like a trader on GMX, I think that's like probably less risky than being like a liquidity provider on GMX. And I think if you're like a trader on DYDX, like that's probably less risky, but you're trading off like centralization in some element there.
So can I ask a novice question? So like on DYDX, for instance, I deposit funds into the protocol. So they're holding the money. It's out of my wallet at that point, right? They're custodian of my funds. At that point, it's at risk, the same way that it was at risk for FTX.
Yeah.
No, I don't think it's at risk in the same way, because like funds on DYDX, like I believe this is a little complicated, because you have where the trades are settled, you have where the account balances are stored, but then you have like the order book engine, the maxing, the matching of like the buyers and the sellers and everything. DYDX like has a lot of stuff on chain, like the settlement of the trades, I believe, is on chain. I believe like the storage of the funds and everything's on chain. But like running an order book is like very computationally intensive and can't really be done on like even layer 2 Ethereum as of today. So a lot of that matching engine is done off chain, and then the trades sort of settle on chain. And that's one of the reasons why they said they were moving to Cosmos, right?
Because they went from ETH then to Stark. And they're saying even Stark is too expensive for them to run.
Yeah, like I don't fully understand how they're going to execute this. Like I still think a lot of this computational stuff is going to happen off chain, but there's some way that Cosmos exists where like these nodes are going to be kind of processing this, and they're going to kind of like distribute it across all the nodes to get that performance.
I really like your framework, by the way, Nick.
Yeah.
So I want to work through the conversation in that framework.
talked
It
about
helps my brain.
We talked about trading pairs. I think when it comes to network, like mainnet is secure, StarkX, Arbitrum, Optimism, they settle on mainnet, so like more secure. I forget which one is. Maybe it's a G Trade on Polygon.
It's on Polygon. I think they're coming to Arbitrum.
And so
soon now.
that's a side chain that is still exposed to like a 51% attack
I
hypothetically.
think we should probably even zoom out a little bit more just as a starter and just talk about the different ways that like DEXs exist on chain, because there are different ways that DEXs are set up.
Are you talking about order book versus AMM or something
like
else?
order book versus AMM versus Oracle. Like those are sort of like the main ones.
I want you to answer a question like, to what extent should a user care? Like when should they care that it's an order book versus AMM versus
depends
like
on who
synthetic
the user
liquidity?
is. Yeah.
I mean, some of these are promising like never-ending liquidity, which
Well, let's go like one by one, I guess. We'll talk about like what they are and the drawbacks, right?
Okay.
Like the first one is like the AMM, and that's the Uniswap. That's the model we're like really familiar with, and then that's a little complicated because Uniswap also came out with Uniswap, V3, which is different in a particular way. But like in an AMM, you basically just have a bunch of capital. Like Uniswap V2, right, is just a chunk of capital. So if you're trading Ethereum versus USDC, there's literally a pool that just has 50% of the value of ETH locked in it, 50% in USDC. And the price is determined just by the ratio of coins in the pool, which is just determined by supply and demand. Like
Right.
if
to
price,
maintain 50%.
yeah, like if price of ETH moves a lot on an exchange, like arbitrageurs will come in and they will just buy or sell from that pool to the point where like the price in the pool matches the price in the exchange. And like this is like a elegant model in that it's very, very simple.
Yeah.
Right.
I mean, the formula itself is very simple.
Yeah, it's like three variables.
Yeah, like you can, if you want to get into this, a listener wants to like search X times Y equals K is like the kind of a very simple formula to kind of determine price and in these AMMs.
And I think Uniswap like took hold because it was so simple. Like you didn't need to make an account. You didn't need to log in. You didn't need to do any of this stuff. You didn't need to care about, oh, do I need a limit order or a market order? That doesn't even exist. Like the price is just the price. You just put tokens in and take other tokens out, period, end of story. And you pay 0.3% or 0.1% or 0.05%. Like they've come out with other pools now that even have lower fees. So as like a trader, like if you're like a huge whale, like and you want to come in and just swap $10 million of ETH at market, like you sometimes get like way better execution doing that in DeFi than you do on like an order book.
I mean,
like
you
on
might move the
Binance.
price, you might have slippage, you might move the price and suffer some loss. But you're right, because in like a traditional order book, what exists, you need really deep liquidity in an order book, because the order book says if I want to buy Bitcoin at 10,000, there has to be an identical seller who's willing to sell the same amount of coins at 10,000. And so imagine all the different limit orders and prices and the amount of money that people want to move. You need matching at all times, which is what DYDX does, which is different from GMX. GMX uses the AMM model, as I understand it.
GMX uses the Oracle model.
The Oracle model. Okay,
Yes,
can you
which we
explain that to us? Because that one's new to us.
you want to just get off the AMM model real quick?
Well, unless you have anything else to
Well,
dive
quick.
into.
I think it's important to just talk about the quick like pros and cons, right? So I think the AMM is generally great for traders, like people who just want to swap stuff. Not a lot to worry about. The fees are relatively low depending on your size and everything. And the problem with AMMs, and we talk about this a lot in the Discord. I get a lot of people who come in like, I want to be a liquidity provider and earn yield. This is where the AMM, like a Uniswap, is bad. So if you're not trading, but you're the liquidity provider, that's where people get wrecked, because like one of the things about being a market maker, right, is you are sort of quoting this bid-ask spread on exchanges, right? You're effectively like putting an option out there at all times. Like people have the option to buy from you at this price, sell from you at this price, but they don't have to. So to be compensated for that, like there's a spread between those things, because otherwise you would just be getting killed by, like, we talk about like toxic order flow as a market maker. Like you don't want a bunch of it's like being like a casino and like a game, like a sports betting situation. You don't want some super savvy sports bettor coming in and dumping like 100 million on the game, and then you only get 10 million in soft bets. Like you just get wrecked. Same thing as a market maker. You protect yourself by having this wide bid-ask spread, and you try to avoid, like, quote unquote, like toxic order flow. As an LP on Uniswap, like all your order flow is kind of like tons of the order flow comes from like arbitrage bots who are basically taking a price that is, or they already know is good on like Binance, and then like hitting a stale price on Uniswap, and then you are you're basically like leaking value as an LP doing that. Like you're kind of getting killed. So I don't recommend people like be a liquidity provider on that stuff, because
tallying the con as liquidity provider for AMMs.
Yeah. But so after AMMs, right, we've got we call them like CLOBs, like centralized limit order books. Like this is like the order book model. It's like an exchange, right, where you have people quoting buys and sells, right, like in the same way as an exchange. This is DYDX, right? Very similar to a regular exchange, except
this is how Coinbase works too, right?
Yeah,
it's
this is
exactly
how like
the same.
New York Stock Exchange works. You say like, I will buy this asset at this price. I'm willing to buy it, and then there's somebody that's either going to match it, or they're going to say, yeah, I'm not really there yet. I'll sell it for this, and somebody has to match on either side.
Mm-hmm. So the pros of the CLOB, the CLOB, whatever you want to call it, the DYDX model, it's really, really scalable, which is good. Like if you want to build a business, you want to be an investor in the project, like you want the exchange you're investing in to be able to scale, and that model can scale like basically to infinity. I mean, look at Binance, right? You tend to see this like network effect thing where like the biggest exchange just starts like a black hole absorbing all of the liquidity and all of the volume, and suddenly it gets like super, super huge. And then the final like method we have to do a decentralized exchange is the Oracle method, right? So what oracles are is like Chainlink, right? It's basically like a price feed, and you basically price the price of the asset on your exchange just by some price feed. So example of this, GMX. So when you buy ETH on GMX, the price of ETH is just determined by like whatever the last price on Binance was via the Oracle. When you buy coins on Uniswap, the price is determined by the ratio of ETH and USD in the pool. When you buy coins on DYDX, the price is determined by like real-time market price discovery between buyers and sellers and people quoting those prices. So that is like the critical thing to sort of wrap your head around if you are trading, or you want to, especially if you want to invest in these projects, right? You have to understand, am I investing in an AMM? Is this an Oracle model? Is this sort of like a traditional order book model? Because those things are going to have very different pluses, minuses, drawbacks, like all that stuff.
Can I ask a quick question about DYDX specifically? Because when I use this platform as a user, and I look at a quote, right? Like let's just say I look at ETH. When I'm looking at the UI, it'll say the index price, the Oracle price, and then I can put in limit order, and those will be two different things.
Mm-hmm.
That makes sense though, right? Because the index price was the last transaction made between buyers and sellers.
The CLOB.
Right. The order book.
And then the Oracle is just pulling, hey, here's what.
That's just data.
It's just like, here's what it is somewhere else.
Yeah. And we're getting a little in the weeds here talking about this stuff, but when you are trading like derivatives, right? There's just people they're not trading literal coins. They're sort of betting on the price of something. It's sort of built on top of what the actual spot price is. Oftentimes the volume though is just orders of magnitude of what the actual, underlying spot trading is. And when you have derivatives, you have leverage. When you have leverage, you have to be able to like liquidate positions, or an exchange can get left with a ton of bad debt, i.e. FTX, stuff like that, right? So this question of like how you liquidate positions is like a tricky thing. Like for example, like Kraken has like been like notorious for having these scam.
Kraken.
It's Kraken,
I
bro.
didn't see that coming.
It's Kraken.
Is it Kraken?
Yeah.
Yeah, I've been saying
Pretty sure it's
Kraken
Kraken.
for you.
All right, whatever. We can move on.
Whatever.
It was worth pointing out.
Yeah.
Yeah. I didn't want to let
It's
that
worth
slide.
pausing for.
I did not want to let
Yeah,
that slide.
Good tape on that. It's notorious for having these like scam wicks where like the price of the coin will go, like you'll see Bitcoin, the price goes down to like $700. You're like,
that's
what the hell?
terrible if you're using leverage.
Yeah, if you're using leverage, that's terrible because you're like, okay, I'm sure I'm using leverage, but I'm only using 1.1 to 1, so the price has to go down like 90%. Then it's not going to happen tomorrow, and then it just scams and liquidates you, and then
So
goes
just
back up.
within this conversation of the three different styles, I'm guessing that FTX was a CLOB.
Yeah.
But I'm guessing that also didn't come into play with why they folded.
Well, they played some funny games with their liquidation engine, right? They gave Alameda allegedly preferential treatment in the liquidations. Like if you make one of your accounts, like you can't liquidate them.
Right. This thing can go down forever and create this
The house
unlimited
loses.
black
Yeah.
hole.
Which
yeah.
the house has
Yeah,
in
which is
user
bad.
deposits.
Right.
But that being said, like there are differences like DYDX or Gains Network. They do different things with like the Oracle price versus the spot price to determine like how they handle liquidations, how they handle stop limit orders for people, right? So I don't want to go too far down the weeds
let's
on that
not go
because
down
it's
that road, yeah.
probably not super useful for people. But that's why you see things like Oracle price and trade, like they're different things that are being used by the exchange for sort of different nuanced purposes.
So how does liquidity play to each of these three? Because like I think, you know, if you're moving any kind of like medium sized weight, you want liquidity, right? You want to make sure that there's depth, especially if you're doing things like, I'm sure people wanted to short Sol, but if there's not liquidity, it causes issues. If there's not someone else willing to take your other side, it causes issues, you know? So I guess how do you what's your perspective on liquidity in these three different, you know, types of models? Does it matter more in some versus others? I imagine a order book liquidity matters a lot. Maybe matters less so in a AMM and maybe even least so in an Oracle price. That's my assumption.
GMX is like interesting, right? So the way GMX works is it doesn't have an order book. There's not market makers. It has this pool called GLP. And GLP has a bunch of like Bitcoin and Ethereum mostly in the pool. Also has tiny amounts of like Uniswap and stuff like that. But then the other half of the pool is like stable coins. So it's effectively a pool of like 50% crypto, 50% stable coins, like you know, ETH, Bitcoin, you know, type crypto, right? So that pool is like the liquidity for the trades, right? Whereas on DYDX, there are market makers quoting size and particular prices, right? So GMX, because it uses the Oracle model and it just gives you a trade execution at the price of Binance, doesn't have any slippage on an order. So you could, if there's 50 million of ETH size available for you to buy in GMX as a mega whale, I believe you can just buy 50 million of ETH with like no slippage in one go. So like as a whale trader, there are some things about GMX that are really, really interesting. The downside of this is that GMX has like way higher fees than DYDX for like a small guy. Like I think DYDX has 0 fees for like 100K in monthly volume. So if you're like a minnow trading ETH and you're not putting on sizes where there's going to be a lot of slippage,
100K minnow, huh?
yeah.
Well, that's like
That's like not that
That's monthly
much.
volume.
Like, because
Oh,
if
okay.
you're trading like small positions back and forth over the course of a month,
Okay.
like you can hit like 100K.
But even if you're a
easily.
hodler, like you could actually be a
But
100K
again, it's
trader,
100K and less.
do one trade 100K in a month.
total.
You're not a minnow, but like you just
Yeah,
have
like
not
if you're
done volume.
trading 1,000 a month, you're still in that tier. It's 100K or less on DYDX, I believe is the cutoff. Fact check me on that. There's no fees. So on GMX, they charge you 0.1% to open a position, 0.1% to close a position, 10 basis points, right?
Can we mention our referral link, by the way?
Please.
So there are no fees under 100K, but for people that are accumulating fees, if you use our referral link, you actually get a 5% discount on your fees.
Tell me the code.
Oh, it's a link.
Oh, it's
Hit me with
all
it.
right. Use the code.
Yes, if you would like
make it
to
good.
support the pod and test out.
Yeah, I mean, we debated even
these
providing these
things,
things because,
yeah.
like, who knows what's going to happen with these projects. But in the end, by actually using a referral link, you get 5% discount on the fees. So
We both win.
yeah,
Yeah, I would like to stress, like, if you don't really understand how leverage works, if you don't understand how perps work. We don't want your money. Don't wreck yourself. Like this is like this stuff is it's
don't
tricky
do it
and
in
you
the first place.
yeah, like you can definitely get hurt trading with leverage. So don't do that, please. And also some of these things are less proven than others, I would say. And that's maybe something we can talk about in a bit, because I do think that's like one of the interesting questions as an investor, like which of these models is actually sustainable? Is one of these like a Luna sort of waiting to happen again?
Right.
Something worth worrying about. But yeah, as like a trader, you want to be concerned with your slippage, which is how much the price moves when you put in the order. Like if you market buy something and you buy the first amount at this price here, but then your size moves the price up and then your average price ends up being higher. And then when you sell, the same thing happens going back down. That's sort of like a built-in fee that you pay, which could be quite substantial if you're a whale who's just like mashing the market.
Or you're trading in a liquid token at the time, right?
I mean, that happens in TradFi markets too, on liquid assets.
Yeah. Yeah, so that's one thing. You also want to be aware of the fee you just get charged by the platform for execution, right? Which is in GMX 0.1%, in DYDX for a little guy 0.
A ladder, though.
Have you used Quenta? Quenta seems high. Like the fees on Quenta are so high. Like I don't like trading there.
Quenta like there's just not a lot of volume there
Is
yet.
it ETH only, by the way? ETH USD?
No.
Or USDC?
No, Quenta has a bunch of pairs.
Quenta's interesting because they have like currency pairs.
Oh, you
I
mentioned
think
that,
they have
okay.
like oil. So if you want
That's where I trade my ape.
Yeah, they have like coins that aren't on like other stuff, right? So there's sometimes reasons to use these like little guys, but like if you're just trading ETH, like in my opinion, you just want to use GMX or DYDX. Like if you're trying to make leverage trades, and GMX is even interesting just for spot swapping. Like that's kind of like one of the interesting things about GMX is you can just use it as an exchange
To swap.
and swap
I was
there.
wondering if
And-
any
and
of them can be used that way.
Quick shout out to the Discord. There are a lot of people who have used these projects in there. There are some
Yeah.
developers of these projects in there. So if this podcast maybe creates more questions than answers, like the Discord is a good resource to kind of pop in and ask questions. And
Yeah, after an episode like this, that's pretty common.
yeah.
Yeah.
So I think it's important to mention.
Yeah,
and
this
continue on.
is definitely a little
High density.
wonkier than some of the past episodes we've had recently. But we
Wonky.
like to get wonky sometimes.
Wonky. I don't know about wonky.
Okay, so
so
we've
wonky.
talked about trading fees, we talked about networks, talked about trading pairs, talked a little bit about liquidity. Is there anything else that we should like cover as a user when it comes to like using some of these?
Yeah,
projects?
like execution matters, right? So on DYDX, because of the nature of that app, like you can click the market button and you just instantly market buy something, right? It behaves very much like an exchange. Whereas GMX, like you're signing an on-chain transaction, and it is like Arbitrum, where most of the volume is, and so it is fast. But it's still different than just like executing in an app.
It's not instantaneous. It's like 30 to 60 seconds maybe or something like that. 30 seconds.
Probably even less, but
Okay.
like it is not 0 like DYDX.
The market's moving. You might want to be aware of that.
Like DYDX has much more complicated orders, but you can do trailing stops on there, good till canceled order, like all this kind of stuff that if you're a little more sophisticated, you might enjoy doing. DYDX is way more pairs. Like GMX is really good for like ETH and Bitcoin, basically. And if you're moving size on those things and you just want to, it's kind of cool.
This is why I don't use GMX, because I want to short shit coins, and GMX doesn't let you do it.
Yeah, you short Link, you short Uni, but like I don't know.
Yeah, but
there are better things to short.
I want to go
so-
shittier than that.
Right.
Yeah, case in point, or excuse me, point taken. But yeah, like so, DYDX is cool because I got everything on there. I got like sushi and Cardano and like
And
tons of coins.
They were kind of a beneficiary of this FTX, fallout, because a lot of liquidity moved there. People who were used to using FTX, let's call it non-US, and shorting some of these shit coins and using it for perps had nowhere to go. And so they found a home in DYDX. Is that right? Would you say?
Yeah,
They
and
got quite a bit of
GMX too. I mean, GMX is absolutely mooned. Token price has been really strong all year. To be
Okay,
honest,
let's pivot. Let's pivot
Is
to
there anything else before we on
let's
the user
pivot-
basis, or
let's
can we
pivot to like token valuation, because I think there's something there too. It's like, should people buy GMX token or DYDX token? There's a lot to talk about.
should you deposit assets for GLP? I have some questions around this, but
yeah, I mean that's another interesting question is like, should you yield farm GLP?
Right.
Which I think is an interesting question.
Can
I mean,
you
the
go-
yield on it is quite high right now, and now you can even leverage it. Like this is where
you can go delta neutral, maybe gamma neutral. We're
we're doing the DeFi thing. We're kind of building these scary like leverage things on top of things. It's like what Vitalik talked about in his blog post. He's like, keep it simple, but we're not doing that. We're building like financial instruments on top of financial
So like
instruments.
I think like when I'm analyzing these things, and I would like to participate in as an investor. Like I want to buy something that's a real business that's generating dollars as a business, and then I can like capture some of that as a investor or like a token holder, right? That sounds reasonable. Like DYDX doesn't pay out anything. None of their fees get paid out.
Right. The token DYDX is, I think, strictly a governance.
Strictly
token. Like,
governance.
you can vote, and that's it.
Right. But the protocol itself is generating fees, like significant fees,
But not to the token.
but it's not delivering that as like a value accrual to the token. And not to say that it will never, but like that's one thing to consider.
Yes, you can't do something like sushi and stake your sushi and then receive your portion of the protocol's fees as a quote unquote real yield.
how
Well, I
does
don't know.
that
That wasn't
compare?
And on the other hand, GMX is paying out fees,
in ETH because the fees are in ETH, right?
Yeah, it's
Right. So it's actually taking the real
You
money.
love that. I remember how excited you were even when like we were talking about looks rare.
Absolutely. I love getting
love
paid off of the protocol itself. Like the
Yeah.
protocol exists to make money. That's why it's there. And if we can participate in that and like become, like that business, that is really compelling.
So Stephen, feel free to break this down in any more detail. But as I understand it, the GMX token gets 30% of the protocol fees, and if you're a holder of the GLP token, you get 70%. So I imagine that like if you hold GMX, you probably have to stake it to some extent in order to actually receive those fees in ETH. I'm sure you get rewarded more of native tokens like the escrowed GMX, the VE GMX, or whatever the kind of like the curve equivalent of that they have. Is there anything like?
What's up with the GLP?
Well, this is where it gets a little more complicated because as I understand it, you have to deposit one of the assets that's in the pool. Again, the side of the side of GMX that's taking the other side of the bet. So on one side, there's users saying, I want to go short ETH 10x. And the other side of that bet is this a pool of assets, ETH, BTC, WBTC, stable coins. And the way it gets in there is someone deposits that money and in return they get GLP. And essentially you're playing the house in that case. And the house, according to the documentation, gets 70% of the protocol fees. Now, the part that I'm trying to understand is, when you use the word the house, it has this like assumption. The house always wins, especially in a casino, right? And so what I get a little confused on or have a big question mark is like, let's say you want to play the house in a, decentralized perp exchange. Can the house always win? Can the house fucking lose big? Because like, I feel like we're making this big assumption that like, yes, GLP holders, by putting some assets and being the liquidity provider for the house, you're getting crazy yields. So I think they're over 20%, but that must mean there's some kind of a counterweighting risk that resides. And if you look at over the course of GMX, the house has over the long run won.
Yeah.
But what I'm worried about is like, is there a day when the house could lose? Big boy trader comes in and wins big and withdraws all the tokens
Highly profitable trading strategy just comes in and wrecks.
So I don't know. I would love your kind of like overview of what you think this is and what's the best way to describe it and what the risks are.
Yeah. I mean, so first off, I don't own either of these tokens, and I have reasons for not owning both of them separately. They're very different. As far as GMX goes, like your analogy of describing GLP as like the house, I think is a good analogy. It's a good narrative, right? Okay. In aggregate, normally as a trader, right, or somebody who's buying on an exchange, you're kind of going against like two people. You're going against the market makers and you're going against like the exchange. the market makers are quoting like a spread on you. You're losing some to the spread, and then the exchanges on top of that are taking like a percentage of the trade as a fee. So these are the type of things.
Your EV is negative from the outset. Like being a trader is net negative EV to begin with
because of the fees, right?
Just because of the fees.
Okay.
Yeah.
Yeah, like if you're just a monkey throwing a dart at a board, like going in and out, you pay the spread, you pay the fees, so you're net negative.
This is why like passive investing has become so popularized. It's like because they say, well, you're at least not losing that little spread.
Yeah. So as you said, like trades come from GLP on GMX. So as a trader, when you put on a position, that position is basically fronted by GLP. And GLP, as we talked about, is this like 50-50 basket of like coins and stable coins, right? And as you also mentioned, when you buy GLP, like there are additional incentives that say like, hey, we'll give you a discount if you put ETH in here. You buy it with ETH.
Because we need it. Because the pool needs it.
The pool needs ETH. Or if the pool's like really short on stables, so you can kind of mint it at a discount depending on the asset you're putting into it sometimes so that it rebalances, right?
Can I make a quick point of clarification? Because it helped me as I was kind of learning this thing. You don't buy GLP on Uniswap or any decentralized exchange. The only way, as I understand it, to actually hold GLP is you have to deposit one of the assets that the pool needs. So ETH, you don't go on Uniswap or another decentralized exchange, right?
It's minted.
Right. So that I don't know, that helped me in understanding how this thing works.
Yeah. And so the idea at a high level is that the GLP holders are both like the market makers and the exchange collecting the fees wrapped into one. So as like a GLP holder, you are benefiting from like just the net trading fees, right? But also the net negative P&Ls of traders who over time, at least on GMX, has been shown are negative. I think one of the interesting questions is, does this like actually persist? And it is kind of one of the, literal billion-dollar questions around GMX and whether or not it's profitable to use GLP or to be a holder of the GMX token.
One of the reasons I like this narrative is like when you get on these platforms and you realize you can trade with leverage, it's literally the best casino in the world. It is like it's better than being in Vegas. And
I would say that the spreads are tighter than like sports betting. Sports betting has a 10% spread anytime you make a wager. This is tighter.
Okay.
So it's not as good as that.
Right.
And,
if you have an edge, yeah.
Yeah.
Yeah, you're right. Like if you've got like 10K and you want to go in and out on DYDX on like an ETH leveraged long, well, you pay 0 basis point fees, and if you do limit orders and you basically pay no slippage, you're sort of just YOLO gambling, and you're not paying like this massive vig. And there's like an element of it that's kind of fun, like people do. Like watching the numbers go up and down on the charts, like if people are in crypto to gamble, so there's all sorts of ties together. Not necessarily allocating people to do that, but it is what it is. Like humans like this. So I see the narrative as a whole being like good and investable because I think humans like to gamble. That's one of the reasons they do
this
crypto.
Particular set of humans that like to use DeFi, like to gamble, which is why I like the narrative. I was just kind of shocked that like on the whole, traders net lose money. Like over the long run, you lumped all their bets together and you sum it all up, they're negative. And I guess I shouldn't be shocked by that, yeah. but I guess I just don't know. Like in blackjack and in craps, it is mathematically set up so that over the long term, the player will lose and the house has an advantage. But I'm not sure that necessarily exists in these.
Doesn't that apply to every casino game?
Yes, it does. It does. But like, I'm wondering that doesn't necessarily apply here, right?
No,
like people
but it has to for it to be sustainable.
But these things might not be sustainable. That's the point.
Right. So like that, therein lies the question is like, maybe if it didn't have leverage, maybe traders would make a profit over long term. But when you introduce leverage and people get liquidated,
the more I
then
think about
maybe
it,
that's the small
GLP sounds awful because you have this risk that Avi comes in and just nukes profitability for the liquidity providers, and you're capturing, would you say 20%? Like that's not even enough to incentivize. Okay. I actually think it's lower than that. Like the yield is probably lower than that. I don't know. Is it 20? I don't know.
I don't know what it is now, but like it's been historically like over 30%. I think it's probably around 20% now.
Yeah, it's pretty solid. I would guess it's around 20%.
Okay, so let you. I think you brought up a question that layers on an additional layer. So when you hold GLP, you're the house, and there's these set of assets. And you're right. If big boy trader comes in and shorts ETH, and we're on the wrong side of the trade, all the ETH gets zapped from the pool, right? But what if you could set up some sort of hedges against that to make sure that you're neutral, regardless of who wins on the other side? Is that what, when people say delta neutral, is that what we're talking about? Like when we're trying to say, okay, I want to just earn the yield from GLP, and I know the portfolio of assets that are in this basket, so I could set up hedges.
But that portfolio, that basket is not stagnant. It
changes.
It
right?
changes. So you have to modify your hedge as that portfolio changes.
This is
so someone set this straight for me.
This is a good question, and this is definitely going into the wonky range again. You can't be delta neutral in these LPs because of gamma and the convex nature of it, right?
And specifically because they're changing all the time, right?
So
that's the gamma.
Yeah, when we talked about AMMs and why like being an LP and like Uniswap for most people, like I looked up a stat actually. Somebody did an analysis of Uniswap v3, just the ETH USDC pool, and the pool was down like $100 million. And it doesn't really shock me because people don't understand what they're doing, right? Like what a Uniswap LP position is a short gamma position. And if I just said that and you're like, what the hell does that mean? Like you shouldn't be in Uniswap.
Okay, well, can you also explain that? What the hell does that mean?
I mean, yeah, it's like when you talk about options, right? You have this thing called delta, right? Which is sort of the rate of change of like the value of your option as like as the price moves. There's a derivative of that called gamma. So like as price moves, the rate that delta affects your option exponentially increases or decreases, right? So it's this non-linear relationship that makes it very difficult to hedge. It's just moving target, whereas stuff goes, like it becomes this like exponential function.
It's the reason why TradFi almost got taken down by GameStop is because of this convexity.
Great example.
Yeah, so that
was a gamma squeeze.
That helps. And like I don't think there's anything we could say on this podcast to make anyone really understand delta and gamma. Like you kind of have to just sit there and read and like go through examples. Like, you know, I think months ago I was trying to understand this better. Investopedia is a good place to start, and then kind of, you know, dive
yeah,
deep.
Like the question for you as like a GLP investor is like, are the fees you are making, so, like there's obviously an amount of fees where there's just so much cash raining down from heaven that you're willing to be short that gamma, right? But what is that point? Like, I don't know. And then there's also this, like when I think about this at a high level, right? All of this trading, it's all inherently a zero sum game, right? And in a traditional order book, like the slippage, the spread on the bid ask is sort of like the price you have to pay for liquidity, right? Like somebody is taking on some element of risk, and to compensate from that, like they have this spread. So now we're giving traders like zero slippage trades. There is no spread there.
But so we're talking more about the one that like doesn't matter. Like we haven't talked about GMX. We only talked about GLP, which we already sort of like cast aside.
But I am talking about GMX right now.
Okay, so GMX, you earn trading fees. Trading fees are going to persist whether or not there's profitability or not, or convexity or not.
But the price of the GMX token is going to just instantly go to zero if like a black swan happens and something of the pool is like exploited in a way that like people don't
correlation
understand.
To GLP, you're saying, obviously.
Yes. Absolutely. Yeah. And I would also argue that like I was looking at it today, like the fees generated by the protocol itself are not sufficient to justify the price of GMX token. I mean, it's about like a 15x price to sales, and like I could get Coinbase for 2x. Like, and Coinbase, I'm just much more confident in.
But is it price to sales or is it like price to earnings?
It's
price
actually
to fees.
It's kind of like an earnings because it's like it actually
'cause
takes the 30% of the total fees, but even still, it's like way lagging. You know, like a better opportunity with less risk. I mean, you've already mentioned how risky it is.
I don't know if it's risky. Like, and to be fair, like spent a lot of time like thinking through how it might blow up.
I mean, like
people's thoughts.
The fact
on how
that it can
might
blow up, you should be paid for that. Meaning, like you shouldn't have to pay a higher multiple for that, and you're paying a higher multiple than you are on Coinbase. Like that doesn't make sense to me.
I don't think you're paying a higher multiple on Coinbase though, because I don't
No,
think
you're paying a lower. You're paying.
I think you're
that's
paying
my
like
point. You're paying a lower multiple on Coinbase, and Coinbase is a better.
Yeah, but
exchange.
Coinbase is a price to sales, which I think is like it's more
It-
top
yeah,
line,
yeah,
right?
yeah, of course. So, but I'm just saying you strip out that 30% and then compare them, and you're still paying higher on GMX.
I mean, I wouldn't buy GMX over Coinbase if what you're saying is accurate. There's no way I would.
That's what I'm saying.
That like makes.
That's what I'm
sense
saying.
to me.
I would say that there's a strong business case for a decentralized perp exchange to have fees, but there could be competitive pressure in, let's call it centralized exchanges, to not have fees, right? Like this could be like a race to zero in terms of transaction fees on an exchange where like Coinbase may not be able to.
And at the end of the day, what I'm saying, just to be very clear, is that I like getting fees from a business that is good, but there are many businesses that are good. It's not just, it's like, it's less focused on this is decentralized and this is centralized. It's like, I just want the best multiple on a good business.
Yeah.
I mean, is there a situation where I can buy GMX, get the yield, and then like, I don't know, hedge against GMX, like the token going down, or is that just kind of like too complicated and
you could hedge via perps, like if you have a Binance account, but then it's a question of like, what is the cost of your hedge, right? Like it may cost you 50% a year to have your hedge, and then you're earning 30% yield, you lose money. So like with most of these like low market cap coins, you can't hedge. You're just kind of naked. You're just balls out, just hoping that everything works out. And all of this stuff is just very much on the frontier. Like nobody's made these products before. They haven't seen like the full breadth of all of the shit that can happen in the world. Like they're called black swans for a reason. Like people don't anticipate how they might go down, right? So I think it's fine to invest in these things if you're using like small amounts. You just kind of want to let you have like a thesis. It's cool, but like I get so wary when I'm just on Twitter and like everybody and their mother now is like shilling GMX. At a certain point, it's like, okay, everybody's shilling it. We just had like maximum volatility, which is good for trading fees and volume, combined with like maximum capital outflow from centralized exchanges. Kind of feels like peak local mania to me at like a bare minimum.
Yes.
Right?
And just to like, I just want to say that back to the conversation about Vitalik, where he was saying like the future of blockchains, like these apps, particularly DYDX, GMX, like these are the most useful apps I've ever used on a blockchain.
Yeah.
So there is reason for optimism as well. Like I'm not going to shit on anyone for saying like buy GMX now, because like this could be the future. It's just like it might take 4 years for that thesis to realize.
Good point.
Yeah.
You guys want to do a 4-hour podcast on this?
why? What are we running on?
We're
over an
into
hour?
We're
Okay.
we're well
no.
into it.
Oh no.
All right. Well, we can.
Nick, do you have any things to wrap with? And then I kind of have one question to kind of bring it back to.
I
where
think
we started.
I'll defer to Steven and see if there's anything like kind of closing points on like maybe what we should be considering from the investing side. I mean, in general, I like this thesis. I think like in a bull run where there's a bunch of liquidity pouring down everyone, like people like to play casino games, and this is one of the best casino games to play. And like if there is a safe way to play this, you know, I want to be aware of it. And so these are on our radar. It's on my radar.
Yeah.
I don't know if I'm buying it now, but I would like to keep an eye on it.
I think what Eric said is good. Like I want to invest in stuff I use, and like I use GMX a lot. I use DYDX a lot as a trader. I think they're like DYDX especially is like the shining example of like what you can do with like this sort of next generation Web3, whatever the hell you want to call it. Like it's a really interesting app. The token sucks as an investor, in my opinion. I don't own it, but like I'm just really interested in that niche. I think as an investor, like you should be looking at all of this stuff all the time. Like even if GMX doesn't work out, well, I don't know, maybe it's like the Ask Jeeves, but you wouldn't have like not invested in Google because like Ask Jeeves was kind of lame. Like there's something here that we should look at, but we also should be like super cautious and critical of it, because we are building like pretty dangerous products from a point of like financial leverage and just all this complexity that's going on. We don't have like a good barometer for what can happen. and sort of like these 5 standard deviation scenarios that pop up every, so many years. So you got to be careful with that. Don't go like all in.
Well said. You guys did good research on it.
Yeah.
Yeah, Eric and Steven, good job.
I think we've touched on a lot of these points throughout, but just to summarize it, I'm curious what you guys think are the primary drivers of this mania. Why really? Is it the outflows from centralized exchanges? Is that really the primary one? Is it because everything is so quiet and we're in a bear market?
Good
and
question.
People are looking for
Yeah.
something to scratch.
I think we've identified that you can't hold your money on an FTX,
Yeah.
on a centralized exchange. So like,
Right.
what's the next
What's the
alternative?
next best place
But-
for me to get my fucking...
But then like I'm still
that what's
worried that
going
like
on?
you can still get freaking rugged on chain too. Like that
Absolutely.
happens all the time.
But anyone in there right now is like the strong of the strong at this point, right? So it's like it's a very different user as
Yeah.
well. So
It-
they
that-
they
and
should
that's a good
hopefully know what they're
point.
getting into.
It's a
It's
I mean,
different user.
a very different user.
I mean, just to be clear, I have like a fraction of a percent of like my liquid, net worth that
Yeah.
I can actually move around on a day-to-day basis. Like it's, and so maybe that puts it in context.
Your degen,
Yeah.
a little degen back. It's like in the days when you do a favor for the king, and you'd walk up and he'd just give you a little perfect little baggy leather with like a little string around it. Like that's
This would be sufficient. Man. He tosses you your vague sack of coins.
7 shekels of
Oh
gold.
God, what was the comedian who had that? I forget
Louis
it.
C.K.
Yeah, Louis C.K. Yeah,
Yeah,
it's
can
great.
you do that for us?
No, I don't know. the skit.
Please
I don't know the
do it.
skit. I don't know
Oh,
the
it's
skit.
such a good skit. Can you put it in the show notes?
Maybe.
Can you find it?
Yeah.
That'd be great. All right, boys, this was fun. I'm excited for the next episodes. And I guess to wrap, this was obviously very dense.
I'm
come
curious
to our
if people
Discord.
like these dense episodes.
Yeah, that's a great question.
No, I think they're
Was it too
I think
much,
they're-
too little? Where was the
I think they're
overall-
mandatory. I think they're mandatory because
agree.
like not only like
We're not evolving if we're not having
not
this
only
conversation.
are they useful, but it's also like authority building. Like we know what the fuck we're talking about. Like we're doing the deep
Hey,
research.
Daddy.
I think it's important.
Okay.
Like,
Oh,
I mean,
putting
also-
that cock punch on the table.
But also we had this question. I mean, it was coming up like when we
Right.
didn't have a mic in front of us, and we're like,
Yeah.
well, shit, we should probably dive into this. And
I agree with Eric.
Yeah,
I mean, obviously, there's
I got a
some
lot.
some
I
brains
got a
at
lot
this
more
table.
here. I could have gone for 3 more hours.
No,
So
I
if
know.
If you have,
I know.
if you have questions, come to the Discord.
and if anybody
talk
wants
me.
to
I have-
use these protocols, use our referral link.
Yes. So all links at alfalfapod.com. Hop in the Discord, and the referral link for the exchanges are below in the description.
Beautiful.
I'm gonna sneeze. Stop the episode.
Okay, bye guys.
Oh, it's gone. Okay. All right.
Held
Bye,
it.
guys.